So guys, so I started actually in 1990. Basically, came out of university. I was a bit of a let me just say a high. I was a high elite athlete and a very compulsive gambler. And used to bet on the horses, used to bet on our games. I used to bet on everything. So one of the guys that was actually working with me or playing with me in the team, he was running Citibank, and he's like, "Oh my God, you're an absolute freak. Really good at everything you do, and you've got this risk appetite, which is, if we can harness that, then this is going to go a long way." So I started in the Citibank graduate program. They interviewed like 250 punters. Took two of us. So I was one of those guys. So I started in Sydney at Citibank, worked there for 5 years and sort of outgrew the desk. I went to Citibank London for almost 5 years, and then across to Citibank New York, in and out for the next couple of years. Came back, started to head up Commonwealth Bank of Australia, sort of New York and Sydney mainly. And then I ended up joining. I had like a break for a year. I was sort of cooked when I was in my mid-30s. And after a couple of years of traveling the world and just doing stuff and realising everyone else was at work and it's pretty boring, I got back into, I was approached by TD, Toronto Dominion Bank, and there's a bunch of guys I had at Citibank who were all running the bonds there. They got me over there to sort of head up the FX at Toronto Dominion for a couple of years until I was once again cooked, and then I sort of came out and just started trading for myself. I set up, actually I'll tell you how Traders for Traders got started, and then that'll lead into everything else. Basically, I went to some of these expos, right, and this is sort of, I guess, around 2008-9, just before the global financial crisis, and had a look around, and a couple of the guys that I work with were running or working for brokerage firms. They said, what do you think? Have a look around. I'm like, well, there's lots of tech here, but no one knows what they're talking about, right? And this is the difference about what we're going to be talking about today is trading in size and actual real trading compared to going to an expo and sitting and listening to someone that has been trading out of their garage for a couple of years and trading 5 or 10 lots or 20 lots. It's like, oh my God, this is like pathetic. Now, a lot of the guys that actually do work in the banks or different fund managers, there's like a code, right? You don't sort of go around spruiking yourself. That is one thing you don't do. If you're out there sort of telling everyone how good you are, then usually you are terrible, right? So the best traders, and I learned from a lot of gurus and legends about execution, how to manage the risk and a whole range of things, which I'll discuss. It was sort of like taboo that you promoted yourself. And actually, the better you were, the more introvert you became. So it's quite funny, right? Because the whole market now, like what we're doing here, it's all about telling people what's happening in this and, giving yourself a pat in the back for the stuff you've done. But it was never the case in the real market. So that's probably why you don't hear a lot about what we're going to be talking about, how to manage huge volume, manage the risk associated with that, because there's a couple of different things, right? And I guess as I get into this, I mean, I've just basically worked all over the world, Sydney, London, New York. When you're a senior trader or a manager at these banks, you're constantly traveling, meeting other teams, meeting other managers of other banks, and you're developing relationships everywhere. So when it comes to talking to people, there's like about a 3-degree of separation in the financial markets, because each organisation has different teams, but you know people in different ones, and you can connect with anyone, right? So basically, we all know each other in one way or the other. So now, one thing that, and just looking at the slides before this, having a look at the general markets themselves, I'm sort of looking at the markets, and this is, it's LSEG, but it's a metastock sort of product. I'm always looking at the markets, and if you don't know what you're looking at, well, then it's pretty hard to work out exactly how you're going to make money, right? And just understanding the connections between the equity markets, the treasuries, and then the impact on the currencies is your starting point. And that can
Brad, we still see your last slide there.
Oh my God! You know what? I must be streaming. Let me just share.
I think just bring it over.
Yeah, hang on a second, man. I think I've got it. Yeah, but that's weird, isn't it? So I've got this on a VPS. Let me just try and work out. So I am on the same screen. Oh, here we go, screen. Sorry, man. My fault, man. All right. There you go.
Okay, so we see the big board now.
Yeah, that's cool. So I was just, this is a bit of background sort of stuff at the moment, but as I was just saying, I line up, this is like a dashboard, right? And this is your starting point to just understanding what's happening in the market so you can anticipate the next move. Now, let me just come back to some of the things that we did, right? And, you know, you hear a lot about Soros and these sort of guys. They are the size of the funds they've got are huge. And we used to have some of the big funds that were managed by Soros. They had different code names like Star. There's a whole range of them. But these guys are transacting in huge ticket size because they've got massive portfolios. They're trying to get into trade. So they're looking at the markets technically the same as everyone else, right? But what they're going to try and work out when you are transacting larger, right, you've got to be a little bit more accurate with your entries. And because you're trading with such high volume, you've really got to try and they usually scale in, right? Now, there's two parts to understanding how Soros and these guys would instigate a trade. And there's one key component that I would ask. So we used to deal through, you know, you have the main trading desk and then you have the sales guys or the sales team, which is, you know, about 300 dudes, and there's about 50 traders on the main desk. He would be asking you, you know, I've got the phone. You'd have a special phone, right? The phone would pick up. He goes, "Holy shit, Soros is calling us," and you're like, "Yep." And everyone's listening, right? Because when this phone rings, you're going to be transacting somewhere between 2 and 10 billion, right? And you're like, "Holy shit." Because when you've got that sort of volume, you are in control of that country's currency for that period of time. And it may take a few days to transact this stuff. Now, the first question I would ask him is, like, you know, you give him a signal, put the phone on hold, and I would ask him straight away, is this a new position or is he closing out? And the guy's job is to know this, right? Because it's got two different meanings. If he's getting in, they are so exact with their entries. If they're getting out, they don't give a shit. They're just taking profit. Like, just buy them, just get them back. You know, who cares? So this is the thing, right? So if you're trading like the normal trade size, you know, 100 million bucks is neither here nor there. It's a decent clip, but it's not going to, you know, really move the market too much. Now, if you're trying to transact 10 billion, which we did it on a few occasions with Soros, is you've got to. They look at a number of different things, right? They look for markets. So for instance, I don't exactly have a pen here, but they're looking for markets. So if they're selling, they're looking for strength in the market, because you cannot transact without pushing the currency down a huge way. You cannot transact that amount of volume in the markets. So, you know, and the positions I used to run personally were somewhere around, I guess, overnight and over the course of a day, about 350 million. So, which is basically on most of these currencies, 35,000 US per pip, right? So now if I went out and got on the cans, the thing could go up. Say I was long. I used to get calls, right, and guys ring me up saying, "Look, you're up 5 million bucks." I'm like, "Holy shit, really?" And then by the time I got in the next day, coming in a little bit hungover, I'd be down 1 million. I'd be like, "Oh my god, that's terrible." But the problem was, even with 350 million, you can't. It's like trying to sell a house, right? It's not exactly a liquid asset. The bigger your volume in the market, the harder it is to transact, and you have different problems, right? It's not about just identifying. Say I'm looking at the daily charts here, and I'm looking across to, say, the major currencies. It's not just about, looking for a good entry point. You've got to start to consider other factors to manage the risk and exposure of those positions as you get in. So when I was at Citibank in London, when Soros, as the story goes, broke the back of the Bank of England, right? And I was in that team transacting. We were all hitting sterling. Could you imagine 20 senior guys? Usually there's one or two guys managing the currency. We were all hitting it, fucking just massacring the thing. And this actually wasn't. This became a not just a transaction. This actually became a point. Soros wanted to make a point that he could take down one of the central banks. And the Bank of England, the old lady, being one of the oldest and most prestigious, there was no bigger thrill, I think, for their team to beat the Bank of England. And what I mean by that is the Bank of England, sterling was collapsing, right? And if I just go back into, let me just get up a long-term chart here. I'll be able to show you the, it was back in the 90s. Actually, I probably don't need to go back that far. So sterling was starting to plummet, right? And the Bank of England's holding it up, just buying, right? We saw this with the Swiss National Bank in 2015, made an absolute meal of it, right? And you can see this move here, actually 92-ish, 93 there. This thing collapsed from 199, 50 cents, right? This is a good old chunk. And Soros was a big part of that. But that transaction, this is more of a story than anything else, because once the Bank of England started buying and holding sterling up, they made a point to actually, let's just see how deep their pockets are. And they just keep driving and pushing and smashing them. And that's where actually it gave fund managers a bit of a bad name, but it also alerted central banks they are not necessarily the kings of the markets. They are long-term, but over a short period of time, and I'm talking 3 months, 6 months, maybe a year, they can lose control of their currency value by huge fund managers pushing these things around. Now, it's a bit easier when the fundamentals support your view. Now, let me just sort of come back and give you some sort of shape here around some of and just looking at those slides that Bruce was mentioning before about managing, was it $1 million account, Bruce, or 10 million? What was that?
Yeah, it was $1 million. We're contemplating 10 or maybe more, but this is our first time. We'll do $1 million.
Okay, so let me just tell you about some of the pitfalls that traders will have when they are doing this. We have a program where we started giving traders, $1 million accounts to sort of to get up the curve on. This is to go from trading your own amount of money, say it's 10 grand, to sort of building it up. It's a process of skill that needs to be developed to actually mentally prepare yourself to actually manage that sort of transactional size. And this is why in the banks, as I said, I started in 1990. You start with $1 million, right? Maybe you're trading, 10 lots, 20 lots, whatever it might be. And you're transacting, you're learning how the market works, where the entry points are, what happens when it breaks trend lines, the impact on the market. Understanding the behavior around these trend lines is critical to working out how to transact. You don't need to think about that when you're trading, say, a couple of $1 million, but once you get into the $1 million and you're trying to, instead of transacting, say, 10 lots, you're trying to transact 1,000 lots or something like that. It doesn't just change your mental picture around how you're going to manage position. You've got to start thinking about, hang on, you start dealing with amounts that can move the market a bit, whether it's temporary or not. And if the market starts to move against you and you're dealing with large, the numbers, the P&L numbers will change, and that mentally is very hard to deal with. So my experience over, I reckon, about 5, 6, 7 years of dealing with our traders who were good traders, but when we stepped them up, they froze, they choked, They could not manage the execution. They could not manage the exposure. And what happened is, and this is what I think you'll see on your program, is they become outrageously speculative and losses were incremental. Right? So there's a number of different things you have to think about when you are trading, big volume. So depending on what instrument you're trading, okay, whether it's futures on anything. So with the currencies, commodities, like in actual fact, at $1 million account when you're transacting, it's not going to like shake the market down, but for you personally, it's going to shake you down, and it's going to highlight the areas and where you are weak, right? Weak in your understanding of market knowledge, weak in the area of market execution, weak in managing volume, weak in managing your emotions. This is why, like, they spend years at the banks training guys like trained mercs to be emotionless, to be exact, to be objective, and to hit the market and hit it hard, right? And that's what you've got to get, and it doesn't come overnight. So it's interesting, right? Because I see some traders that blow up their accounts in a matter of days, right? And some of them I'm like, oh, here we go. We've got a guy. We've got a guy not too dissimilar to myself. He's got a great risk appetite. Now what I've got to do is I've got to try and teach him to control that risk appetite with precision. And that's where trading bigger accounts comes into play. You've just got to think. And I try and explain this to people. When you are looking at the markets and you see sort of big moves happening, it's like just pretend it's like your small account, except you're just dealing with bigger numbers. Nothing really changes, okay? Now, what will change is if you have something like, I've just got dollar Swiss here, say it goes through a resistance level and there's some strong US numbers, well, the problem is when you have a very large position, as it breaks this level and it takes off, the impact on your P&L is a lot more significant, right? And that's where you can automatically just start, like, get a gag reflex and start vomiting. We had junior guys on the trading teams vomiting in bins all the time, especially when they started. They just can't, their body can't handle the pressure, and it just reacts, and it's like a volcano, just projectile vomiting. It's quite amazing to watch. So this is anyway. So coming back to like as you would read everywhere, right? And I saw on the schedule for this week, one of the guys is talking about the psychology of trading. It's epic, right? And it's epic. It goes a long way. So just think of all the things that you know how to do really well, whether it's a sport, it's a hobby, maybe it's just going for a walk. You're really good at it. Think of those things and how much time and effort you've put in over the years to become really efficient at that, so you don't worry about your performance, whether it's tennis, golf, skateboarding, sailing, anything. But people come into the financial markets and they think, oh yeah, I can do this for like a couple of days. I've got the handle of it, and they get into it. But I've seen guys with 10 years experience, right, come into the market. You give them bigger volume and they freeze, right? Because it's all of a sudden, it's real, it's big numbers, and this is your chance at the big time. And 95% of punters will not last more than a day. Okay, I'm telling you that. Just not as a you're going to fail, but as a, like, get yourself prepared for this. So, and this is where your understanding of the market, as I was saying, is really imperative. Trying to work out, like, at the moment, we've got the US Treasury yields driving the US dollar higher, right? And that's sort of based off a bunch of things, largely attributed to, this whole US election coming up. Donald Trump gets in, big tax cuts, massive tariffs on overseas companies, really strong for the dollar, so to speak. It'll crush a lot of other countries, but that's, you're looking at various aspects of understanding the market geopolitically, fundamentally, and then and just economically, right? So, like, looking at the data, how that influences things. This is where if you're transacting big numbers, you need to get a bit more exact with your precision and your decision-making process of when to pull the button or pull the trigger to execute, right? And sometimes around these big key events, it's not easy, because if you're trying to transact around fundamental data, okay, there's less liquidity in the market. There's more slippage. There's less volume going through. And then, like a minute or two later, all the volume comes back and everyone's in there sort of beating each other up. So trading with massive size, and you come back to, say, sitting in the bank and someone taps you on the shoulder and says, we've got a client on here, one of Cyrus's several funds. He wants to sell, like, he's got to sell like 3 billion. I think this is a classic, right? Sitting in Citibank London, I was in charge of the yen and all the yen crosses at that point. I had two young guys next to me who had 5 years experience, 3 to 5 years experience. So they were good bookkeepers. They could transact for me if I just sort of said, look, just knock out a couple of 100 million euro yen or this and that and the other. But when the shit hit the fan, that's when they would actually run the other way. It's like, where are you going? This is like just getting busy. We had a guy ring up and say, listen, we need to sell 3 billion euro yen. And I'm just eating some toast and having a coffee first thing in the morning. And I said, well, that's going to be bloody hard, isn't it? That's liquidity at this time of day is not great. Ideally, if you're trading the yen in 5 or 10 billion, you want to be transacting in the Japanese session, right? That's where the liquidity is. Anyway, I said to this guy, mate, is he opening a new position or is he getting out? And he comes back and says, he's getting out. He's getting out. So, okay, good. So there's no real pressure, because if the big fund managers are getting in, right, they talk to each other. So if Cyrus is getting in, and this is how the game is played, Cyrus would get in, he'd sell 5 billion. Then they would call all the other fund managers they know that they went to Harvard with, or any other Ivy League school, and they'd be like, yeah, Johnny One Nut, we're selling euro. Fuck, okay, so are we. So then they all sell, and that's when all these big things go down. That's the privilege of being in the know. So anyway, this guy says, okay, we need to sell 3 billion euro yen. He said, I need to do it now. And I said, mate, we can't do this in one hit. I'm going to push euro yen down like 3 cents, like 300 or 400 points, right? The fill's going to be terrible. He goes, I said, the quicker you want it done, the worse it's going to be, right? Because what they usually do is, if they're trying to transact large amounts, and this is, say, right for dollar yen, if they're trying to sell 10 billion, he'll probably sell 1 billion every day and try not to move the market too much. If you sell 10 billion in one hit, the thing collapses and everyone's aware of what's going on, right? So the idea is they sell 1 billion a day. So you're just in there constantly grinding, selling. And when he's finished, then they call their friends, then everyone sells, then it collapses. And you think they're a genius, right? All it is massive insider trading. So anyway, this guy says sell 3 billion euro yen. I'm like, holy shit. Okay, I can do it. Let's start doing it, right? And the most important thing at that stage is looking at the current levels, finding out where the critical levels are as far as looking at support and resistance, because you need to know exactly where this thing is going to take off. And when I mean take off, if it breaks key support or resistance levels, then it's going to accelerate. So you need to be ahead of the curve, know where they are, because if you get there, you've got to make different decisions about trying to get in or manage the risk. Now, as an independent trader like yourselves, you need to know, you want to know this, because that's where that's your chance to shine. If you know where the market's getting in and getting out, well, you're ahead of the market, and that's where things can that's where your P&L will really kick into gear. Now, so I started selling this 3 billion. It took us about, like non-stop selling, because after a certain point, especially if it breaks through these levels, there's no one's buying anymore. And when no one's buying, it becomes loose as a goose. And then you start to see these things drop like a lead balloon. And he's like, just keep going. Anyway, so we kept going. About 3.5 hours later, the young guys are counting up all the tickets. The thing's like 400 points lower. And I'm like, oh, yeah, that's good. I've probably made $500,000 just out of transactional stuff. So that's not like proprietary trading. That's just transactional income. They're trying to work out the average for the guy. And I'm like, okay, this is good. Someone go get me some food. I'm starving. And so I sat down. I reckon for 10 minutes, a guy walks in with a burger, and I'm starting to eat it. And the guy jumps up, comes over. He is sweating. He's red. He's like just completely fucked up. And I'm like, and he's trying to talk to me. And I'm like, yeah, what's going on? He goes, oh my God, I've hit the wrong side of the market. I'm like, you are shitting me, right? He goes, okay, look, this is the problem. He needed to buy those. We're going to go and buy 6 billion euros right now. I'm like, mate, we have just ripped the market a new hole, and it is gone. Like, if we start buying now, this thing is going to go up 700-800 points. And he goes, why? I said, well, we're the main seller. We're the only seller in the market. So when you see the only seller in the market come back and buy, this thing, everyone will jump in ahead of us, and it's gone. He said, runs back, do it. I'm like, oh my God, this is going to be cataclysmic. And actually, as a trader at the bank, what the other traders, and we all know each other, and we all try and bash each other up every day, is they go, oh, that idiot got it wrong. It's like, and that's what I'm thinking. I'm like, they're going to think I'm the idiot. Anyway, you get past that. We started transacting. The thing bounced like 700 points, right? The guy must have lost like hundreds of millions, like on the transaction. And this was a simple case of taking profit. But what it highlighted was a couple of things, right? And this is sort of more relevant to actually transacting, large amounts, is you've got to know a bit more about all the critical levels in the market, right? And this is why, if you guys aren't into technical analysis, I can tell you the fund managers are, the bankers are, everyone is, right? And if you have levels, you need to be very critical of where they are, because that's where momentum will shift. And if you're not ahead of the curve and you don't know this, you can use it to your advantage if you are speculative trading. And that's what I would call it that we are all doing. Like, for instance, this level here, okay, you can see how it sort of crashed a bit through, bounced back, and then it's just capitulated. That's very commonplace structure of how technical analysis is. Comes down, tests the trend line, support trend line, probably has a little bit of momentum to push through, and it's a false move. Someone's pushed it, bounces back, holds, and then finally capitulates after retesting again. This is a sort of structure that you should be aware of, because when this happens, it's on for young and old. So if you're transacting, right, I'll tell you one trick that actually I used to teach a lot of the junior guys about transacting large numbers. Actually, well, just in transacting or trading in general. We had a lot of guys and a few clients that had situations where they just could not manage the anxiety around trading large volume. Okay, so, and it's very commonplace. So when you put a trade on, when you first start trading, your heart's beating 100 miles an hour, right? Well, and that's just trading 1 or 5 or 10 lots. Now, you go try and trade 100,000 lots. See how your heart's going then. I can tell you what, some of these guys, it used to sort of pop out of their chest. What I used to say to a lot of them, just to sort of calm them down, is when you put the trade on, just assume straight away that's a losing trade. You've lost, right? And they're like, how do you feel? Oh, well, I feel better. Like, terrible that I've lost, but you know what? I feel no anxiety, no emotions. Okay. Now, the position is still on, right? And they're like, oh, okay. So you're sort of trying to transition from being emotionally erratic, where you will not make any decisive trade decisions, to being calm in the moment, looking at, it's just a trade, right? The whole situation. So when you're trading large, right? There's no room to really get out cheap, right? So you have to be more exact. And with that more exact sort of profile, actually, you know what? I think I've got a pen here that I can use because I need to show you some stuff on the chart here. No, that's not it. Oh, I'm on the wrong thing. Anyway, so what I was going to say is so when you are transacting in a large amount, just think about the volume that you're going to be trading and the levels you're hitting at. So if you're trading on the release of, say, US CPI numbers, or like the Federal Reserve are making an announcement about interest rates or some sort of announcement, you need to be conscious of those, because when you come back to the market, that's going to impact your ability to execute. Okay, so you've got to be conscious of the economic fundamentals. You've got to be conscious of the various markets, equity markets, what they are doing, the bond markets, okay, the yields, are they going up or down? If the yields are going up, there's going to be pressure on the equity markets. Then you're looking at the various instruments that you're trading. Where are the key support and resistance levels? Where is the overall trend? So then you can start to compare various aspects, and you can go, you know what, with precision, this is where I need to get in. And in actual fact, I can actually diversify my risk on the entry, right? So stagger your entry. Now that's going to alleviate some of the pressure immediately, because instead of trading, say, 1,000 lots, you're trading like 100. And then you're just going boom, boom. If the market's working for you and going the right way, then you can go again and just get the trade in. But the most important thing is actually having the plan before you do anything, right? So you do your analysis. This is why all the bankers have systems like this, right? So they can actually see the market in one view, and they can make decisions around what they're going to do, right? Because there's two components to the trade. And this is where, unfortunately, a lot of novice traders they do them as one. And what I'm talking about is there's two parts. There's the analysis and the fine-tuning of the actual entry levels. Where are the critical support and resistance levels? What's the trend? What's the focus with the economic numbers? How is that number? If it's strong, is it going to impact the instrument I'm trading up or down? What are the interest rate probabilities of the central banks? I need to know these because their policies or changes, the economic numbers could impact their future decision around interest rates, and that's going to drive yields up, equities down or up, currencies up or down. So you do all your analysis to the point where you go, so if I come back to, say, euro yen, and if I'm looking at this and I'm like, okay, so I've made a decision. You know what? I'm going to get long euro yen. Now you need to just so stage one is all the analysis. Stage two is where are you going to get in? When you isolate a level to get in, then you need to go, okay, now what is my plan to get in here, right? And this is where you need to switch over from a human to a cyborg and just go, right, these are the levels I'm going to get in. And unless something dramatic changes in the global markets, this is the execution. And just stick to it, right? So you've got to be exact. And what that does is it takes out all the pressure. It takes out the analysis pressure. It takes out the execution pressure. You can actually sit there and just execute the plan, right? This is where most people come unstuck, because they do their analysis and the execution and everything and the trade plan all at once within a couple of minutes. It doesn't work like that, right? 90% of the work you do is analysis, right? The execution, it's probably like 1 or 2%. Right? Getting the trade plan and your capital management structure and understanding, okay, what happens here if this trade loses? Where's my capital management in the scheme of things? And if it's, you need to understand that, because then if you can quantify that, that's going to alleviate some of the pressure that you're under putting the trade on. So always trade within your own capital management system, right? And rules. If you have drawdown levels, where they are. So if this transaction fails, are you out of the game? or are you still in it? So this is, and when you build capital, the idea of trading, and this is how we were trained in the banks. Like every month, our P&Ls reset, and it's like to keep you focused. But every month, what we would try and do in the first week is graft some cash into the account. Like, so if I'm up like 50 or 100,000 bucks in the first 3 or 4 days, right, now I've got some money to play with. That's how we traded. You need money to play with. So make sure your first couple of trades are spot on, maybe a smaller trade size, get some cash in your account, and then start to scale the positions up, right? What that does is it builds confidence, it builds structure, and actually, most importantly, you're making money, but you're trading with money that you've made, and that takes all the pressure off, right? Now, where success comes in is actually, and this is like being a trader for a long time, where success comes in is dealing with the success. I'd say this is right up there with one of the biggest pitfalls for new traders to the market, or traders who are stepping up their trade size in a competition like this that you guys are doing. They just think they're, and not to be crass, they don't think their shit stinks. Once you start making money, you think you're Superman, you've got all the answers, and you know what, I don't need anyone, and your plan goes out the window. All of a sudden, you're transacting just huge volume on opportunities that you wouldn't usually even blink at, right? That you wouldn't give, 2 minutes of consideration to. So so there's stages to your growth and development. Stage one is being able to analyze the market correctly. And when I say correctly, the same way the institutional bankers and fund managers do. Because if you do that, then you're looking at the markets with the same eyes they have. You're more inclined to make the same decisions when they do, and you're trading with the market. Now, that's just the first part. And in the banks, that could take you a couple of years to learn that. Then the next step is learning how to execute, right? You get the execution process, right? Understand where to get in, where to get out, how to execute, how to trigger your orders, how to stagger your stop losses, how to set up a trailing stop, all these components. Then from there, they start giving you small volume, and then it's seeing how you can cope, and you slowly increase the trade size to a volume that is making a big difference. Instead of trading like the kindergarten stuff that you see the mums and dads trading, all of a sudden you are making, 10, 15, 20, 30 grand, 50 grand a trade, right? With that comes a certain level of pressure and understanding. And understand you aren't going to win all the time. Some of these trades are going to lose. So you need to know how much you're going to lose. If I'm putting on trades and I'm picking up 30K, I'm probably only risking 5, right? So, and I can do that because I pinpoint the entry level to such an exact level, and I get the timing exactly right, so I can use less risk on the entry and let it run on the top side. Now, that's a skill that many traders will never have, okay? But what you can do is get close to it if you understand the dynamics of everything. Right. So you start, as I go through this, right, you start to sort of see, like, even a guy that learns how to fly a jumbo jet, right? You don't just sort of walk in and start flying the jumbo. You probably started out flying little Cessnas, and then stepped it up into whatever jumbos, then he's into G7s or whatever it is. It takes time to learn how to fly these things in different weather conditions, different climates, different countries, different runways. There's all these different components. It's no different to the financial markets. You're trading like the one instrument. Most people will trade 1 or 2 instruments predominantly, and I would encourage that. Like your scope for trading is quite vast, and I use a lot of other instruments for correlating factors, but 90% of your trades will probably be in 1 or 2 instruments. Stick to the ones that you are good at, right? And with that, and when I say that is because you can develop, it's almost like a kindred spirit with the instrument. You can feel the movements. You can feel the liquidity when it goes out of the market. You can feel like the oxygen in the market when it disappears, when it's back, the movements. You'll start to get a feel for, false moves. You'll get a feel for real moves and how various economic fundamentals impact those moves. So that's what I mean by spreading yourself thin across different markets. you can really come unstuck, right? Now, associated with that, now, before you get all excited and you start thinking, okay, great, yeah, I've been trading, Euro futures or whatever it is for 5 years. I know that one. Okay, how have you gone on that thing the last 5 years? You made no money. So get off it, right? People are such like habitual, and and I don't mean to be sort of mean. People are so habitually like just wrong, right, that they keep going back to the same thing that hurts them, right? And primarily it's because, it's like you're just doing the same thing. You're not going to get a different outcome. So like change what you're doing, change instruments, change what you need to do, because if you're trading large volume and you have one or two trades and you start choking up, the game is over. Right, so get ahead of the curve, upskill yourself, and actually this is the hardest part, right? There's so much crap out there online about how to trade and how to transact, how to analyze the markets, and there's a million different ways you can do it, right? Ideally, you want factual information, right? So maybe your Bookmap has that information in there around where the volume is and all this sort of stuff. That's something you can use very, very a lot to basically help you know where the levels are. Now, I don't want to sort of blow things up here, but let me tell you how we used to, especially in New York, right? We used to do a lot of transactions on the floor, especially in the futures market, to move the currencies, right? So you've got the spot market, which was sort of done internally in the banks, and we'd have, Reuters and a few systems that sort of transact between each other. And then that would be all like stealth. If we wanted to make a noise, we used to sort of get the guys on the futures floor to get on their chair, scream as loud as they can, we're buying, we're doing this. Basically, we use the futures markets to manipulate the markets all the time, right? And it's sort of like a thing and all that. You're not supposed to be manipulating the markets, but every day, that's what every institution is doing. They are trying to manipulate the market to get you to think something different. As I was saying, so Soros, if he wants to sell, 5 million US dollars against the yen, right, he needs dollar yen to be going up. So what they would do, generally speaking, is they would buy in one session and sell in another and try and manipulate the futures markets, and then always trying to manipulate everything. So even with a lot of the volume trackers in a lot of the systems, we would get the guys to load up huge volume in the systems. So it looked like there was huge buying around. And then everyone who was looking at that would start buying, right? They're like, oh my God, all this volume's coming in. There's all these orders to buy, and they're massive. And then the market would start going up. Then, you know what, they'd call the bank. So, okay, we've got it up for you. Go to work. And then we would go out and hit the market and just smash it. They would pull all the orders, and everyone's like, where did all that buying interest go? And it's disappeared, and then it's gone, and they're smashed, right? So that's a component of the market that a lot of people don't know about, and it's hard to. Sometimes this is happening whilst we're just sort of going about our day, and you're like, oh my God, someone has just stitched the market up, and I've been caught up in it, and you can't help that, right? But what you can help is if you've got a trade plan which is precision, and so if it goes through certain levels, you're out, right? Stick to those levels, because if there's manipulation going on in the market, you just don't know what it is. So you've just got to deal with these anomalies. I would sort of call them anomalies, but they are market events most days of the week, and deal with those in your plan, because at the end of the day, someone who's manipulating the market may actually trigger your stop loss, and then the market reverses dramatically, and you're like, hey, that's not my fault. It's like, whatever you did, it's your fault. Factor it in. If you're upset about a loss, and you will have losses that you are disappointed with, but if you're getting angry, it means you've traded too much. You traded more than your account can handle and more than your brain can handle. So the whole key aspect of you guys starting to trade big or bigger, right? And when I sort of talk about Soros or whoever, the bigger fund managers who are trading huge amounts, they have a lot more pressure. Well, pressure, the amounts they trade in comparison to how much money they have under management, it's minuscule, right? So there's really not that much pressure on them. But the main thing that you need to think about is getting a bit more accurate with your entry levels and then also with your trade plans. You need to be able to swear, like just go, this is the level without any, like try and take the subjectivity out of it and just remain objective and go, this is what I'm going to do. This is why I'm doing it. Everything lines up, and that's where you can have a lot greater success. Now, and just coming back to technical analysis just briefly, if you're trading, right, there's one thing here that we can see, right? And so you can see trend lines. This is the key parts of trading, like using analysis and these sorts of things. My screen just stops moving around. Okay, so these support and resistance levels, right? The one aspect we don't know, like we know exactly where this major support level is, right? 183.60 on sterling yen. And, you know, you can sort of come in and start sort of like putting in, like, where's the short-term sort of support trend lines, these sorts of things. You know where all these levels are. It's about the one key aspect, the very last aspect of the trade, which is 1,000,000% important, is the timing, right? You just can't go in and get short sterling yen wherever you like, right? It's only going to break this level at a certain time. Now, unless you are a cyborg, you can't sit in front of the screens for 24 hours a day. I'd say about 80% of the good trades you're going to miss because they occur when you are not in front of the screens. When you're asleep, when you're out, you're doing things, you just carry on with normal life. They pay the bankers, right, and the fund managers. They get paid, you know, shed loads of money, and it's why? To sit there and waste their life in front of a screen, right? This is the problem I had at the very end. I was losing my marbles because I was staring at the window and just thinking, what the hell am I doing here? I've got to sit here for like 10 hours and like stare at a screen. I'm not getting paid enough. And you sort of are, but at the same time, you know, you look back and you're like 70 and you're like, I wasted 40 years staring at screens. It's so that's the problem though. But they pay them that much, and they have global trading teams. So when it does go through these levels, someone in their organisation is on it, and they are hitting it with the right timing. Okay. Otherwise, if you don't get the timing right, you're going to have huge risk parameters. You're going to have huge stop losses, and what that does is it means you're going to reduce your position size, and that reduces your overall potential returns, right? So there's like a catch-22 here. And I'm not telling you to stay in front of the screens all day. What I'm saying is get fine-tuned. There are systems here that you can actually come back into and place call levels in the market, right? So if I was trading the euro, I could come down here and set an alert, right? I could set alerts to alert me so I don't have to spend the time in front of the screens. You know, if it gets to a certain price, I can actually go in and basically set this thing to email me, text me, anything, right? The aim is try and get the timing right for the trades that you're going to be doing, because if you're trading bigger amounts, right, it's important. Now, the other thing, when you start trading these large amounts in this competition, don't go in like some superhero with maximum trade size, right? Do some work. You can do this before you even actually get the account, before you start, is work out, okay, so what trade size, how much can I afford to lose? Then start to work your trade size from there and stagger it. So when I make $5,000, okay, my trade size doubles, or it's 1.5 times bigger. When I make the next $5,000, it's double. So you're building capital, but what that does is it limits drawdowns, right? Keeps you in the game for a longer period of time, and that is going to give you a greater chance of success, because you only need one good trade with a 3-to-1 risk reward ratio, or even bigger. If you get a trending market, you're going to make sort of 7, 8, 10-to-1. You get one trade right, you are a superhero. Right, that's the difference. The superheroes that come out and start trading maximum trade size, they only get 1 or 2 chances and then they're out of the game, right? Any risk manager looking at that, they would never get a job, right? You would never fund them. You would never do anything because they don't have any structure. And what we do with some of our stuff is, I want to see, we've got 2 programs. You can come in and try this stuff yourself. And yeah, we'll fund you if you go all right. But if I'm looking to build guys into my own trading team, I want to see how they perform without me telling them what to do first. That's where I look for risk appetite. That's where I look for control around capital management. 98% of people don't have that. So it's more, you got to think about what skill set you have. As I started at the beginning, where are your strengths? Where are your weaknesses? Are you prepared to go and do some work and get those skills? Because if you're not, well, you're kidding yourself, right? You're never really going to make huge, consistent cash. Because I can tell you the people who do make consistent money, they trade less than you think, but they are more accurate. And because they're more accurate, their trade sizes are bigger, they're probably doing a 20th of the trades you are doing, right? So the more transactions you do, the more likely you are to lose. So you got to think about that. These are like just things that I have seen over 15 years of running a funding program as well as like some trader education stuff. It's like, I just don't get it. And I know I'm a bit privileged in the sense of I've had, a long history of trading. So it's like a mechanic, right? You drive your car into a mechanic, you don't know what's wrong with it, but it's got that sound. And he goes, I know what it is. Any mechanic with 20 years experience can fix any part of the car in minutes. That's what you get with longevity and learning a lot about what you're doing. Now, I know a lot of you guys might think you know what you're doing. Some of you probably do. The rest of you, you want to sort of spend some time trying to get up the curve. And there's no like quick fix here. There's no like, okay, I'll show you a couple of things and that should do it. It's like when I play a lot of golf and like all the pros, they are continually working on their swing, get in the groove, keep the shape, everything, right? So that's what you need to be doing. But hopefully through this presentation, I've sort of given you some, I know some of it's anecdotal, some of it's, like the big fund managers, how they transact, with precision. They try and time it so they're working in sync with the central banks and policy. So if the dollar's trending up or down, they can try and anticipate that, right? They can come unstuck if that, or they wait for the central bank to really give them a signal. By then it's already moved a fair way, but they can still get in. That's why you stagger your entries, okay? There's no real need to stagger your exits, right? When it hits the exit button, you get out of everything, right? So, but your entries, you get a lot of control there. And as I said, you can control your emotions through how much capital you put on the trading opportunities. Oh my God, there's a lot of talking there, Bruce. What are we thinking?
Wow, that was fantastic. Many points that will be, I think, really, really helpful for a lot of people for the competition and for just for any of their trading lifestyle. A question on the exit. So what about staggering some of the, taking some partial profits along the way? Or are you using, I remember in the past, like you would say like, well, a lot of times we would also, buy some out of the money puts, insurance policy, type of thing, but it's expensive. It adds up. It takes away from your bottom line. But because You've talked about the entries and the precision and the control that you can have in the entries, but exits, though, is a different story.
Yeah, the exits, you're right. So definitely as part of your plan, it is good to have exit like a partial profit levels, right? And get used to taking profit too. That's probably one of the biggest problems for most traders. They don't know when to take profit and they leave a lot of cash on the table. So what I would be doing with exits is 100% incorporated trailing stop loss. That's having a trailing stop loss that trails the market. Say euro as it broke higher here. that is more inclined to keep you in the trade with the trailing stop, right? You have your optimum profit target, which may be, say it's 300 or 400 points, right? And that's not going to happen in a day. It may happen over the course of a week or 2 weeks or 3 weeks if it gets going. So your trailing stop is your backstop, but it keeps you making money, locks in profits in case it turns around. Now, on that path up, yeah, I think it's wise to have some partial profits. So, maybe 150 points. You take 25% off the table. At 250 or 200 points, take another 25% off the table. And stagger those out to try and keep in the trade as much as you can, and then hit so by the time it tops out, you're either going to hit maximum profit, or you would have partially taken profit and your trailing stop would have closed out the balance, and that's how you really maximize your profits. It's actually like if you just have your stop loss and just leave it there, you're a sitting duck, because you could be up 200 points and it reverses and you lose. That is demoralizing. You'll start experiencing performance anxiety because you've had this winning trade, but it's now a loss in your account. So having plans for your eggs that's not just where you stop out, but for where you partially take profit and take profit is another important component. I'd say when I was at Citibank in London, at that time we merged all the European trading teams into one room in London. It was the biggest FX trading team in the world. It was an amazing thing to be a part of at the time. But the biggest problem in the room was the guys were always looking for that big Hail Mary trade, and they had a problem with taking profit, right? And I didn't, and I actually made the most cash. So the taking profit is a skill that you need to get. Usually when most people get in the cash or get a trade going, they're like, this is the big one. Oh, yeah, this is the big one. They start looking at houses and cars to buy and these sorts of things. It's like, and then all of a sudden it's back lower and they're looking for a new job. So the thing is, take profit. You've got to take profit. But then on the other side of that, if you take profit too early, you're never going to make any money. And that's the other problem for traders. They don't take profit, or they take it so early, they're like, because the anxiety of trading, they get into the position, they're out of the cash, and they're like, oh my God, this is not good, this is not good. They all of a sudden see a couple of grand and I'll take that. Oh, wow, I feel better now. But then the thing runs 200 points and you would have made 30 grand, except you're sitting there with your $1,500 getting performance anxiety as well. So there's a whole bunch of things that can happen. And when you start getting performance anxiety from not taking profit, you are on a crash course to losing, right? You lose confidence, you lose control of your capital. You have one big trade, then it's all over. Boom.
Yeah. Great to hear. I don't know. I mean, like, I think I had a whole bunch of questions here, but I think you answered all of them as you went through. Yeah, I mean, I guess maybe one on the execution, because, a lot of us are the analysis part. You can get good at the analysis part, or, get some skills and learn about different things, et cetera. But the execution part is rarer to find those skills. And how would you recommend getting better at that?
I mean, there are a number of things online that you can get, like some tech, right? Just get some tech. It is. And like transacting what we transact here using these platforms these days is a breeze, right? Compared to trying to transact manually, hitting voice brokers and manually doing everything in the day was terrible. But that transaction in the old days would be at least a 2 to 5 year process of learning how to execute properly. And what I mean by that is when you're executing, it incorporates manipulating the market, trying to do this, do that, then get out of the position. So we don't need to experience that, but like a lot of the platforms, they are getting better with their execution process, but you need tools that can get you in to the trade and actually apply your complete trade plan to that entry ticket, right? So it's worth investigating. I built some stuff years ago that I still use to this day to actually do that. right? So you put a position on, it's got a stop loss, it's got to take profit, it's got structure around your trailing stop and partial profits and these sorts of things. So have a look around the market, because you can find stuff. If I just have a, no, I don't know where it is actually. I was going to say I'll just get up a platform and show you, but it's so that's what I would do, because some of the platforms are limited, right? And this is the problem, right? If you use a platform that is limited and you hit the entry, right, all of a sudden, as soon as you hit buy or sell, you're emotional, because you've got attachment to that position. It's not the time to be going to put stop losses on, take profits, trying to set your trailing stops and these sorts of things. Have a look around for tools that you can integrate with your platform, or if the platform actually has it, then that actually enables you to control a complete trade plan from your entry. If you can do that, then like a huge amount of pressure is taken off your shoulders.
Yeah, sounds good. One more question I had was like, when some of these crazy transactions are going through, and it's one trader or a few traders, it's moved hundreds of pips. I mean, the rest of the market, the rest of the world, the correlated markets, I mean, they're all going to be affected. So now what happens? Like, do people start to see this like, here's an opportunity, an arbitrage, or I don't know. I mean, like, to kind of bring things back into line here, or maybe they know that these are trader mistakes, and it's like, well, this is a buy, to bring it back to where it dropped from, etc. How does this kind of play out? I mean, because these are massive moves.
Yeah, arbitrages probably went out of the market around 98, around there somewhere. Because the computer systems and the geeks, the quant teams, got so quick on them that they made gazillions of money, and then everyone learned from what they were doing and shut the arbitrages down. Like in the day, 90 to 98, there was like massive arbitrages across all markets, so you could actually do all sorts of things. But you're right, when big moves occur, like a lot of these instruments, like these major currency pairs, all have the US dollar in them. So depending on what the US dollar does, it should impact them all the same. Now, occasionally you have separate country data, like Eurozone data or German data, impacting euro different to sterling. Okay, so the $1 million question about what you were sort of asking there is, do you get on that, or is it a false move? That's the thing. You just don't know most of the time. You don't know. But if you do your analysis, like even just technically, you can see where there's mismatches, and you're like, hang on, euro's going down, sterling's going up. Now that's a mismatch. These two correlate 98% of the time. Which ones? They're either both are going to correct, or one corrects. So is there a mistake here? And then you can look for other correlating instruments with that and go, well, Aussie's going down, Kiwi's going down, Sterling isn't going down. This is where the trade could be. This puppy hasn't gone yet. And what you would do is you would go and have a look around, try and find out what's going on in sterling. Why is it holding up? Okay, and it may be some fundamental data, maybe a whole bunch of things. So, but if you can isolate that, then you've got a trade in play that you can anticipate and get onto pretty quickly, right? So I was on the daily chart there. So on a daily perspective, that's what's happening, right? Sterling has been outperforming the other currencies against the dollar, but you know what? Then you come back and look like with your analysis, you're looking at two different time frames, long term and short term. So you come back short term and you're like, hang on, this thing is behaving the same as the other pairs. There you go, right? So it's just, what that would be on a daily chart is a difference between the ECB cutting policy, right? The forward guidance, they're cutting rates. The Bank of England, they are cutting, but not as aggressively as the euro. That's why long-term sterling is outperforming euro, right, against the dollar. But then, so we are always looking for mismatches on correlating pairs, and that can give us the edge on the potential opportunity, right? So, You're right there, Bruce. There's things here, as I said, like sometimes if you're trading one, say you trade the euro and that's your favourite, well, don't be afraid to look at what's happening on the other instruments, because that will tell you very clearly what's going on. Like dollar Swiss and euro are like as one, right? But they are opposite because the dollar's quoted differently against each, but they work together. And if you don't know that, well, then you're missing the big picture. But so yeah, like you're just going to keep your mind open. And actually, I'll tell you one other thing, Bruce, which is a massive problem, which I see quite a lot from new traders, is over-analysis. They call it analysis paralysis, right? Where you are just like trying to find the answer, trying to like make sure everything fits. Nothing fits perfect 100% of the time. In actual fact, probably a couple of percentage times, everything will fit perfectly. You've got your entry, your direction, you hit it, it makes money, and you go, wow, I wish I could do that every day. It's because the setup was set up perfectly and you identified it. Now, do not get into a situation of sitting in front of the screens for 10 hours a day, right? If you're doing that, you are not going to be winning, right? The bankers get paid to do that, but I tell you, they are sitting in their chair, but they're not looking at the screens. They're just talking to each other, having a yarn, having a laugh, telling jokes. That's what they're doing. So if they're not staring at the screens like all day, don't do it yourself. Otherwise, you won't see the forest for the trees. Your eyes will start telling you different things. Price action, it's like magical, right? It can make you buy and sell, and you're like, wow, how'd that happen? So but when it is time to concentrate, and that's around the major fundamentals when they come out, concentrate. There's a time to concentrate and there's a time to analyse, right? And that's what most traders need to do, and that's where you'll pick up mismatches in correlations, and you'll see things like just even looking at this, right? I've got oil inverted on this chart for dollar CAD. Now oil's starting to rally, and dollar CAD is finally breaking back down through this support trend line, which goes back a long way, right? Since the hurricanes. So this is a potential move where I would be like, oil is a big control. If this keeps going, dollar CAD is going to catch up. It's going to be down 100 points very quickly. That to me is using a correlation with oil to tell me get ready to sell dollar CAD, okay, or buy Canadian dollars. And then I can go into the Canadian dollars. I can go and actually go, hang on, if that goes, let me check the Canadian crosses and see if there's anything else besides the dollar that may be beneficial for me to try. So there's an endless path of analysis that you can do. You need to get into a habit of actually, I guess this is where, 35 years helps, so I don't waste time on analysis that I know isn't going to generate me any income. That's the thing, right? If you're doing analysis, like I see guys down the pub and they're talking about all this shit about analysis, I'm like, you're an analysis junkie, right? I'm a trader. I actually find the trades and execute. You sit there and stare at the screens and try and tell me, like, you never trade. They never trade. They actually just don't get it. So it's like frustrating sometimes because you can see people's potential, but they just can't get out of the road of their own feet, right? And that's like the financial markets all over, because unfortunately, the whole market, like 99.9% of people who trade don't have the luxury of having professional training, right, that you would get in institutions over many years. And the training in the institutions, it isn't necessarily structured. You learn from the senior guys, like a apprenticeship. And that's where you learn about the correlations and learn about, just do enough analysis so you know what's going on. If it looks good, then investigate. Don't waste time digging around trying to find stuff if it's not going to make you money. That's a big lesson right there. I should be charging money for that one. Yeah.
Excellent. No questions here. So, I mean, you really covered the gamut here. So I think this is one to just go back and rewatch again and again here, and refer to. So you'll live in infamy there, Brad.
No worries. I'll be back in New York probably early next year. Do a workshop and show some of you guys how to do this stuff. And I just see Mr. No Luck there saying guilty as charged. Like, these are things that everyone does, right? And even the pros make mistakes occasionally, but less mistakes and less important ones. But most of the things I talk about are things I've seen from traders internally in the banks as they're learning, and then also from people who are external from the banks who are trying to trade. It's very commonplace. So the main thing is, do not beat yourself up when you make mistakes. As long as you go back and learn what happened and why it happened, and like sometimes the market just moves against you for unknown reasons, and that's not your fault, right? So if you have a losing trade, have a look at it. And this is what I do. I always think, would I do the exact same thing next time? And a lot of the answers are yes, I would, 100%. It's just a market anomaly happened and it blew the position up. But if I come in, I got the execution right, I got the analysis right, I got everything right, but then Donald Trump opens his trap and then it sent the thing the wrong way, that's unfortunate. But that's why I've got a trade plan, right? So do not beat yourself up. If you start beating yourself up, you've got a very short time as a trader, that's for sure.
All right. Well said. Let's see. Yeah.
Oh yeah. I'm just saw the questions, right? That's right, Mr. Nolak. I no longer looking to further develop my technical analysis. Technical analysis is the one thing that you can learn in a week, and there's no need to go further with that, right? That's the key part. When we're doing workshops, I'm like, okay, let's get the technical analysis up because I can teach you that. Like a bunch of monkeys, right? You can just sit there and go, draw the line. Actually, like kids, I should say, is like technical analysis is kids play. And it's easy. It just tells you where things are going, where they've been, and where the pressure points are. So do not spend much time on technical analysis. As long as your technical analysis is correct and you're not over applying indicators, then you've got a bit of a chance. And psychology, fundamentals, you got to understand the fundamentals and you've got to understand the psychology, right? They go sort of, if you know the fundamentals, the psychology will take care of itself, right? But that's a different story. All right, Bruce, hand it back to you, man.
Yeah. No, thank you very much, Brad. This was great, and perfect timing too for the competition. So people can go test it out and feel the pain, feel the nerves, and how they're going to react. And we'll do more of these competitions. So we'll have you back for some more insights and maybe we can get you using Bookmap on some of the currency futures.
Man, that would be amazing, dude. Yeah, no way, man. I can't wait till we hook up in New York again, bro. It's like, let's get out there.
Yeah, sounds great. So, So when are you coming?
Probably late January.
Okay.
I'm doing a workshop in Miami and in San Fran, and I might do one in New York as well. So, if otherwise, I'll just come through and we'll just go out for beers.
Okay. All right. Yeah, sounds great. So. I'll have to get in shape for that.
You get your drinking boots on, bro. All right, mate. It's been a pleasure. Dan, thanks for helping out with the tech. It's been interesting, right? A lot of these presentations, and for the people that don't know, I mean, I've seen a lot of presentations, and they bore me to tears. I don't do any prep, as you can probably tell, but I do know a lot of stuff, and it's a matter of, like, this is where the workshops go as well. You're still more guided by the questions than, because I could talk about this all day. But anyway, hopefully it's been helpful. If you need any help from me, contact me at Traders for Traders. If you need help with Bruce, jump on Bookmap. This competition looks exciting, Bruce. I'll be interested to see how it goes.
Yeah. All right. Well, thanks, Brad.
All right, guys. Well, do you want to just hit end here, Bruce?
Yeah, I think so.
Yeah. All right, guys. Tasha, thanks very much. All the best.
Okay. Thanks, Brad. Thank you so much.